ETF fees might not matter to you in the typical way you think that they should. They could be actively managed, passively managed. It could depend on your goals, your objectives. And no matter how you slice a fee down, whether it's 2.5%, whether it's 0.5% or lower, you're of course always going to pay more for that 2.5% fee. But as always, for context, let's get into it. So before we get into where fees don't matter, they do matter, and all that type of stuff, let's actually figure out first, especially for the newer investors or if you're newer to the channel, how do fund managers extract fees from their products? So we're over here on Investopedia. Let's figure that out. Investment management fees for exchange traded funds, ETFs, and mutual funds are deducted by the ETF or fund company, and adjustments are made to the net asset value of the fund daily. Investors don't see these funds on their statements because the fund company handles them in-house, right? So for extra explanation, if you need it, it's not like these fund companies, the fund managers, it's not like they're scraping away cash from your brokerage account and taking it away from you. It is all handled before you see any kind of return, and it's on a daily basis. So the net asset value is reflected in the price. So whether the price of the fund is up, that gets gained, or lost, a small little sliver is taken off the top right away to account for the fact that you're paying, potentially, let's use 1% as an example. 1% broken down into, 365 days a year, or maybe it might just be broken down into the however many business days there are in a year. So again, you don't see it. It's handled in the reflection of the NAV and the share price. So that is how they extract fees. Let's talk about certain funds that might be a little bit cheaper versus other ones. So first of all, what kind of investor are you? Are you a total return investor, or are you someone who wants to extract money from your, say, distributions? Because with ETFs, we got to use the language of it's distributions. They pay out distributions, not dividends. Companies produce dividends. ETFs produce distributions. But I get it. It's like a dividend, okay? So a fund like VFV, which is a passively managed ETF. It is a low-cost ETF. This is one of Warren Buffett's favorite funds to talk about for those who are maybe want to participate in markets but don't necessarily want to get into the weeds of reports and filings and quarterly earnings and all that sort of mumbo jumbo. Where this is like a one-stop shop. It holds 500 companies. You can invest in one place. You can keep contributing to it, and it just does whatever the market does, right? The S&P 500 is, in my opinion, it's basically the most historic global benchmark that is out there. And everybody loves to compare themselves to the S&P 500. When they say, did I beat the market? Did I not beat the market? They're usually referring to the S&P 500. So a fund like this just tracks what these 500 companies are doing, and they're doing it with a management expense ratio of 0.09%. Now you'll see two of them right here. The management fee is just simply the cost to pay the fund manager. The MER is the total cost. So that will be the fund manager costs, custodial costs, the maybe marketing costs, the trading costs, if there's leverage, those costs. It's basically all the costs of operating the fund. So this is really what we want to look at. That's important if it's out. If the fund is less than a year old, you might not see the MER. It usually takes about a year after the fund comes out for you to see what the total costs are. But at least you'll have some good indicator with the management fee that is listed on the day a fund comes out. This type of strategy, once again, is for someone who is really into delayed gratification. You want to hold on to this for 20, 30, 40 years, and you're not going to touch it. You're going to keep contributing to it, and you feel like that the market will bring you an average return of, like it has historically, of 7, 8%, well into the future, and you'll never touch it. And I got to say, I mean, if you're a rare breed, but again, if that's what you want to do, you want to participate, this kind of strategy is for you, very hands-off. And you pay a very small fee. Now, there are mutual funds out there that are just like ETFs. They act the exact same, where an ETF just holds a basket of stocks, right? Like here, 500 companies. A mutual fund can do the exact same thing. So ETFs and mutual funds, slightly different in the construction behind the scenes, but they basically do the exact same thing. They hold a basket of stocks. But the thing is with mutual funds, especially those produced by banks or maybe some other financial service institutions, can usually end up charging potentially 1%, 1.5% for something that does the exact same thing as this. It's just that this is a little more DIY, do it yourself, that you can set up a brokerage for yourself, brokerage account, I should say, like on Wealthsimple and Trade. Very simple to set up. And to opt into a fund like this is also, again, very simple to do. But potentially over time, the cost of that mutual fund versus this could really hurt you. And so, like for instance, let's just say the mutual fund is 1%, okay? And they do the exact same thing. They are out there. So we got high fee mutual fund versus low fee ETF. At the end of 30 years, you're giving up $423,000 at the end of 30 years versus whether you decided to invest with a low-cost ETF. So for a total return investor, fees absolutely matter. And the more that you compound those fees every single year, the worse it could be for you. So if you are someone who is thinking total return, I want to add leverage, I want to add maybe some other kind of strategy into it. Maybe you even want to add in some kind of option strategy like cover calls into it, but you have the mindset of total return. Guys, you're going to get hit with fees. You're going to get killed by fees if that is your mentality, okay? So again, very goal-oriented here. Fees matter, depends on your goal. Total return for the long term, you should absolutely consider fees and fire the person who is managing your account who says that they're giving you the best deal when, there's obviously better products out there for your total return needs. That being said, let's go and actually look at fees in regards to someone like myself. I don't necessarily care as much about fees because I value my more near-term goals matter to me more than the 30-year goal down the road. And so let's actually get into that. Let's check out a fund like HYLD, the good old darling CoveredCall ETF of Canada, sporting a blistering 13.09% yield. Man, this fund has done some incredible things this year. It's done 3 distribution increases. The last one it did coming into, into April, I guess? That was, coming into May was a bit of a shock. I didn't realize that they would do it again, but here we are. Anyway, HYLD, a staple of my portfolio. It has actually, you know what, I'll explain. 13%. Well, Jordan, you got to factor in the fee. What is the fee? Well, the MER for this is about 2.4%. Now, that 2.4% has already been factored in. Okay, so what you see here is net of fees for the yield. I've also developed a spreadsheet for those who don't know called the CoveredCall ETF ALLSTAR tracker, and you can pick up on my Patreon. It'll be the first comment you see in the description below, but you can scope out fees for yourself here. I've just filtered it based on the most expensive MERs out there for CoveredCall ETFs. Now, I'm going to have to reset these probably in June, July for those trackers. I update this monthly, but come July, maybe into August, by that point, the MER should be reset. And I'll probably have a column here for 2023 MER, and then I'll have one for 2024 MERs. But here we are, HYLD 2.4%. Pay no attention to the 0%. Again, at the end of the day, what matters is this over here. HYLD holds other ETFs that you pay those management fees for. So if you go onto the website, it'll say 0%. But at the end of the day, this 2.4% matters the most. So for 2.4%, why am I okay paying that versus VFV with the 0.9%? I mean, for argument's sake, if we go back into our calculator here that shows us how much things will cost over time, with HYLD, if I invest $100,000 and I put in $12,000 every year with an average return of 8%. So those are the same parameters I used for the other example of the VFV versus a mutual fund that does the exact same thing. I'm going to be down about $921,000 at the very end of it. Because this is an actively managed fund, there's more trading costs, there's leverage, and these days especially leverage is very expensive. My goal for next year is actually to get into a house in Vancouver, a rental. I'm going to be selling off my condo, and myself, my wife, my 3 kids. We're going to move into a house in our target suburb. So for us, that matters. For my wife and I, that is something we have always wanted. We highly value that, and we have always tried to think of ways of how we can do that based on our financial situation. With CoveredCall ETFs, that is the best way that we can get into it to offset those costs of that rental. And basically for us, as it turns out, our living expenses actually don't change at all. So albeit in the long run, as I still invest and I extract cash to supplement those costs, this again for me won't matter as much. But also because I run a channel and because I'm a big finance geek, and I apply action to the education that I learn, the returns, they compound. It's like a weird magic. It all compounds, which I explain in a video over here, how, throughout the 2010s, I didn't invest, and in 12 years, I basically had 45 grand to show for all that, and I missed the best decade. Honestly, I graduated in 2008, and just did not invest whatsoever. Invested in a little bit of real estate with my family, but it wasn't to the same sort of degree that I could have made here. But then you see the difference from 2020 when I started investing almost at the age of 31 and got into the weeds of everything financially related, and I was able to, whatever that is, 4x my money in that period of time, and not by doing anything crazy. It was just continually investing no matter what the market threw at me, contributing regularly, understanding some strategies around taxes, budgeting as well, and just being consistent. And through a holistic view of doing that has actually led to these pretty remarkable returns over time, over the last 4 years. I shouldn't say returns, but it's just, again, contributions, returns, reinvesting dividends, and budgeting, and being able to contribute more, taking tax refunds and using and putting those towards the investments. That has all basically multiplied that over and over again, regardless of the medium. And I've just chosen CoveredCall ETFs because they serve my goals the best in that regard. There could be an argument made where you might say, why not just invest in a VFV and then just sell it off over time? You won't pay as much, it goes up over time. On a total return basis, this strategy, you will make more versus, say, HYLD over time, as assuming the markets go up over time. You could find yourself, this is a cool resource, how the S&P 500 performed during crashes. So it has all these long dips. It shows the recoveries of these big, kind of black swan events in the stock market. Now, here's the problem, that if I hold VFV, I might end up holding VFV here, and I might need to sell it off somewhere in here, which I don't want to do. But through holding CoveredCall ETFs, I still generate a return, and I see that cash on a monthly basis, right? And you can see how long did it take for some of these events to recover. You can see Black Monday in the 80s, 402 trading days to recover. Financial crisis, 1,300 or 1,379 days to recover. I don't want to hold VFV somewhere way in here when something like that may happen. Sell off the return, or sell off a fund at a loss. I could be buying VFV right now if I transitioned everything into VFV, and all of a sudden the market just cools off, and then now I'm stuck. But at least with covered calls, I'm consistently getting a return every single month. And look at some of these other ones, right? I mean, .com, 1,808 trading days to recover. And then the worst one, of course, was Black Tuesday, the great financial crash, and it took 7,256 trading days to recover. Guys, that's insane, right? For me personally, I don't want to hold VFV or any of these sort of long-term total return strategies. As I know, these events just come regular. They're just part of the market cycle. And I think it's just certainly important to understand that they come up regularly. So at the very end of this, I hope this video kind of gave you some context around where fees matter, where they don't matter, or maybe not matter as much depending on your strategy. That's where it comes down to. As long as you've identified a strategy that you are confident in, that you're going to stick with, you're not going to be flip-flopping around, because that also leads to less returns over time. And if you're a newer investor, part of that being doing the flip-flop is just understanding and trying to maybe find what strategy works for you yourself. So for newer investors, I get it. You guys got to go through the same stuff I went through, which is, what works best for me. I used to be a dividend investor, and then I've moved into covered calls for my living expenses that I'm going to start extracting and utilizing within the next year or so. For now, it's just compounding away. I reinvest everything, and I'm not using any of that money for my living expenses. But anyway, as always, if you like what you saw, then do the cliche thing and hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.